Hi, in today's video I'm going to explain to you about two principles of accounting that has to be considered when you set up ERP system. The first principle is the revenue recognition principle. As you can see, revenue recognition principle says the revenue recognition principle directs the company to recognize revenue in the period in which it is earned. Revenue is not considered earned until a product or service has been provided. This means the period of time in which you performed a service or gave the customer the product is the period in which revenue is recognized. So, it is always confusing that you say that I'm not yet get the money from the customer. Why should I consider this as a revenue for this period? That's totally wrong. Once service or product has been given to customer, it is considered as a earning for that period. You cannot have it transferred to the next year or fiscal year. The same principle is about expense recognition. The expense recognition is also the same principle. Let me read it for you. The expense recognition principle also referred as the matching principle. It states that we must match expense with associated revenue in the period which revenue were earned. A mismatch in expense and revenue could be an understated net income in one period with an overstated net income in another period. For example, you have a payroll of your employee, which is quite normal in Iran, that been paid in the next period, for example, the 12th month, and this expense is not registered in the financial ledger, and it creates a complication because, as it said, it's understated the income in this period and overstate the income for the next period. So we have to consider these two principles into our mind when we set up our ERP system: revenue recognition principle and expense recognition principle. And these two principles has to be followed as it is stated in GAAP, and also it is applied in Iranian rule. You have to follow this principle. Thank you for listening to this video.